Hi, everyone. Welcome to the Future of Finance podcast, where we break down investment strategies to help you live a better financial future. I'm your host, Marissa Wood, financial advisor and one of the owners of Union Financial Services. And today I'm sitting down with founder and CEO of $13 billion company, Brookstone Capital Management, Dean Zayed, to break down how we got here, from the Great Depression all the way to modern day investing, and what that means for you today. Now, before we dive into that, I'd ask you to please subscribe, whether you're watching on YouTube or listening on your favorite podcasting app. It really does help us. So, Dean, thank you so much for being here today. We truly appreciate it. For those listening and watching, you're in for a real treat today because Dean Zayed is the founder and CEO of Brookstone Capital Management, an SEC-registered investment advisory firm currently managing over $13 billion, yes, billion in assets. And in this capacity, Dean oversees all strategic growth initiatives, corporate vision, works with over 700 independent advisors nationwide. And he's also been featured on CNBC, Fox Business, Bloomberg TV, has won many industry awards, is a true visionary. And so he will be an amazing treat for us today. So Dean, thank you so much again.
Thank you, Marissa. It's a pleasure to be here. Really, I mean that. And looking forward to our conversation very much.
Yeah. So, Dean, tell me a little bit more about how you got started in the industry and who Brookstone is.
Sure. It's tough to say this because it's been almost a 30-year career. I can't believe it. But almost 30 years ago, believe it or not, I graduated from law school. The story starts there, and I'm not going to focus too much on that. But essentially, I am an estate planning and tax attorney who saw a vision early on in my career to incorporate what we now call wealth management or financial services, retirement planning. Those are the buzz phrases we hear a lot in the mix of an estate planning legal practice that is usually involving the documents, wills and powers of attorney and trusts and so on. So in a nutshell, I'm a recovering attorney turned wealth manager close to 30 years ago, with the idea that I wanted to be front and center in what I thought was going to be a multi-decade growth boom demographically in this country. As a professional doing estate planning, I saw that, we had about 80 million baby boomers, and they really need advice across all aspects of their retirement planning, not just on the estate planning side. It includes the traditional stock, bond, mutual fund type portfolio, that money management component. It includes things like financial planning, estate planning, income planning, of course, which has become a big thing, which we can talk about. And so I made a pivot early on. And I focused on a couple of really key words. I'm going to talk about those a little later. I focused on being an independent fiduciary, very important to me, and I know to you and all of the Brookstone advisors. It's a big part of our DNA as financial advisors and financial professionals. And I started Brookstone with the idea that I wanted to be a leading boutique, sophisticated, independent fiduciary firm helping clients through advisor relationships. The key with us is that we work with what we think are the most trusted, most credible, most capable advisors in the country who partner with Brookstone to then provide this advice to what has now become tens of thousands of American families. So that's kind of the short version of Brookstone, and we can certainly unpack some of that, but it's been a close to 30-year journey, so very exciting.
Sure. Yeah, it's amazing. And it keeps evolving. I'm an independent advisor, as you said, that's partnered with Brookstone in order to scale my practice and better serve my clients, come up with more innovative solutions for them with the support of Brookstone as our back office. Can you explain to our listeners what the difference is between independent advisors and banks or brokerage firms?
Sure. It's funny, that question, the answer starts, believe it or not, in the 1930s, Marissa. I know it's crazy, but most of the laws that govern what we do today as financial professionals were really a result of the Great Depression of 29 when the market crashed. And then starting in 33, 34, and the 1940, the major laws were created that govern and regulate advisors like us. The big difference being, you can be an advisor but be subject to a different set of rules that does not force you to do what's in the client's best interest, right? You have a standard of care, we call it, that's, hey, you've got to do what you deem to be suitable for the client, but not necessarily in their best interest. And that's the 1933-34 set of rules. The 1940 set of rules created what we are, you and I, Marissa, and the Brookstone nationwide, the network nationwide, which are this fiduciary duty that provides fiduciary-based, fee-based, fully transparent advice in which we must, by law, legally and ethically do what's in our client's best interest. And that's the difference. So we operate as independent fiduciaries. There are some great people, trust me, sitting in banks and in some of the traditional brokerage firms. There's some great people out there, but they might be subject to a different set of rules that I think is more 20th century, outdated. And I say, hey, if you're going to sign up to be an advisor or to be a client, why not go with the one that provides the most protection and the most fiduciary driven advice, period? And that's what you and I do. And that's what Brookstone is.
Absolutely. Yeah, because we can work in the client's best interest since we're not captive to a certain fund's proprietary mutual funds or the bank's limited offering. We have countless solutions. And like you said, we are fee based. So it doesn't matter which strategy we're proposing. We
That's
are
right.
charging the same amount. So why wouldn't we do the best thing for our client? It's
That is
kind of a no brainer.
Yeah, yeah. You're absolutely right. And you've seen me use this phrase, and I talk about being an independent fiduciary and being proud that's part of our DNA, and that we have access literally to the entire universe of investment options and vehicles and strategies with virtually no limitations. That's the essence of an independent that does not have to sell a proprietary product or have a sales quota, right? That's the essence of being a fiduciary, where you have access to the universe and you pick and choose what you think is best for the client. That's why we are just so happy to talk about it. I know it makes us smile, but it's a
Yeah.
really big distinction between sort of the other advisors out there that, man, some really good people. But I just say, why shouldn't everybody be subject to what I say is the ultimate gold standard, that fiduciary duty?
Absolutely. And this all came to be shortly after the Great Depression. And I think it has just gotten more and more strict for the client's benefit
Yeah.
over the years. The world of investing is obviously different now than it was in the 1930s or 1940s. And I've noticed just since the time I've been with Brookstone, the solutions keep becoming more innovative. And it's interesting because even with all these regulations in place, most investors are still using pretty basic strategies. Think target date mutual funds inside of their 401k account. But there's so many other tools out there that exist. Can you share one of them? I know is your favorite. Can you share a little bit more about structured notes and break that down for us and our listeners in a way that is the most simple as possible, of course?
Absolutely, sure. Yeah, I mean, it's one of these unique strategies that we've had great success using in portfolios. We've been a pioneering firm in the space, frankly. We're one of the largest investment advisory firms in the country that utilizes structured notes the way we do successfully as a slice or a portion of a portfolio. But if we take a step back, you may ask yourself, what is a structured note? A note in our industry is really code for a debt or a bond, right? So it is a debt, it is a bond. It's a bond issued by the largest banks in the country, all the usual suspects, all those names: Goldman Sachs, JP Morgan, Morgan Stanley, BMO, Wells Fargo, UBS, you name it. These largest, sort of too big to fail banks issue these bonds. They're registered securities, so they have a QSIP and they're registered with the SEC. So it's a legitimate security, like a stock that gets registered with the SEC or a bond or a mutual fund. So very legitimate, of course. But here's the kicker, here's the twist. Unlike a traditional bond that pays you something very, very easy to understand, it's, hey, I'm a company, I'm going to issue a bond because I want to raise some money and build a new factory. And my bond might say something like, I'll pay you 3% a year, every year, as long as the bond is around. And the bond's going to mature. There's going to be a maturity date. Let's say it's a 5-year bond. I'll pay you 3% a year, nothing more, nothing less. And after 5 years, as long as I'm still in business as the issuer of the bond, I will give you your original principal back. That's a bond.
Hmm.
A structured note or a structured bond is a bond. But what the banks have been able to do using the very creative capital market structure that we have in this country, very dynamic structure, the idea behind a structured bond is to say, hey, I can pay you more interest in my bond, my large bank bond, but there might be another twist to it. You might have some risk, and if you're okay, maybe losing some principal, then we might have kind of a good kind of trade-off between higher interest and maybe losing some money. And so if I can kind of fast forward, the bond, the structured bond that we've been utilizing, that we sort of pioneered at Brookstone, really unique to us. Everybody on Wall Street knows the Brookstone bond that the large banks are working with us on. It's really this structure. It's a 1 year bond. We like the short term. It's a 1 year structured bond that says we'll pay you an outsized amount of interest guaranteed in that 1 year, but you can lose money after a year, more or less, if one of the major stock market indices out there, like the S&P or the Nasdaq or the Dow or the Russell, go down by more than 30% in that year. That's at a high level. There's kind of
Hmm.
some nuances to it.
Hmm.
And so we have done all the research. We've been doing this for the better part of 12 years now, where we really like the trade-off of the higher interest versus that 30% 1 year decline, because we know that on a percentage basis, 30% losses in the markets do not happen very often in rolling 12 months periods. So
Wow.
what's happened over the last 10 to 12 plus years, we've averaged about 10% in interest with virtually no volatility in the strategy because we've had hundreds of structured notes and bonds issued, per Brookstone being the lead advisor working with the banks. And if you think about the last 10, 12 years, right, think about how many notes we've had issued. Very few, less than five, have even come close or had issues in terms of that 30% decline. So this
Yeah.
is considered a hybrid type vehicle. It's a fixed income or debt instrument that has these elements of the market that allow you to get the higher interest, but maybe some losses as well. It's a huge part of the growing part of sort of the fixed income being progressive side of our business, where now it's gone from 10 billion a year in issuance to last year over 250 billion. And
Wow.
there's Brookstone really being kind of on the
Wow.
front lines as a forward thinking firm to say, hey, there's a place likely in a portfolio for this. Not everybody, and it's not going to be a majority of a portfolio, but
Right.
probably a good place for a portion of a portfolio for some of these structured notes. And we've had great, great success using them, as you know, Marissa.
Yeah, it's a beautiful strategy, and especially you brought up a important point that yes, you have that 30%. I know we call it like a trigger where, of course, if one of the indexes drop more than 30%, now you're participating in the stock market and you might end up a little less than what you started at or right back where you started or even higher, and get your initial investment back. But that 30% drop doesn't happen often in a 12-month rolling period. And it happens even less often when we do the strategy that Brookstone has put together, which is laddering those notes. If we have a laddered strategy where every month we have a new one coming due, you're decreasing that risk even further. That, it's really almost a lower risk strategy than a lot of other investment vehicles that we look at with clients.
That's exactly right, Marissa. When I talk about laddering, I talk about diversifying around that 12-month period that each note has. So instead of having
Hmm.
one 12-month period working for you, you have five or six unique ones. That's the laddering effect, which further mitigates the
Yeah.
risk of losing principal. You might have one note every hypothetically 5 or 6 years that might have a loss of principal. But if you've been doing this and getting outsized interest and reinvesting and laddering, that one note, if there was a loss, it really gets lost in the wash in terms of the long-term returns have vastly outperformed what normal bonds or interest rates have done. I mean, it's not even close, right?
Hmm.
So the laddering is we took the product of a structured note and we built a strategy around it, and that was the uniqueness of the Brookstone go-to-market version of a structured note. It's not just the product that a bank issues. It's
Hmm.
not us just getting the best pricing on the street because we do the most volume. It was to incorporate that into an actively managed laddering strategy.
Yeah, and I think a lot of our clients listening to this will like this reassurance that that BAMX strategy or even just the manual laddered notes strategy that we've put together for them, it is a winning strategy spoken from, the CEO himself. Now,
Yeah.
why do you think that there's such a lack of knowledge in the industry on structured notes? Why aren't other advisors telling their clients about this? Why doesn't the average person that comes in to meet with us and all they have is their 401k, why don't they know about structured notes?
I think our industry as a whole has done a pretty good job, of educating advisors on the usual suspects, right? Growth was always about stocks or mutual funds. Bonds are meant to be safe and maybe clip a fixed income coupon, 60/40 portfolios. But it sort of kind of begins and ends right there. When you're an independent firm, an independent fiduciary, and like us, I speak for you too, Marissa, as a trusted Brookstone advisor, we have a voracious appetite for knowledge and for making sure that we are on the pioneering side of new strategies. The truth is, there have been a substantial number of incredibly value added strategies that have come to this industry in the last 10 and 20 years. Products, strategies, ideas, solutions that are really, custom built for, let's just say, the retirees now, 80 million strong boomers, the next generation, people that might need income. The idea we'll talk about that probably a little bit here, of risk management. So we have made sure that Brookstone wants to be on the cutting edge as a forward thinking firm with this voracious appetite to make sure that we're implementing the latest strategies and solutions for our clients. I can tell you honestly, we can talk about things like buffered ETFs, for example, that the average advisor, if they just stopped 20 years ago and were satisfied with what we'd say is that traditional 60/40 portfolio, they have missed out on really adding value to client portfolios with some of the new techniques that we've been using at Brookstone.
Absolutely. So, a call to action for anyone listening or watching this episode, if you haven't had your plan reviewed, even in the last 2 years, by an advisor, or you don't have an advisor, you just have your mutual fund portfolio that was set up from your 401k and you
Mhm.
just set it and forget it. Now's the time. Let's have that review. Let's meet and review the latest strategies and innovations that have come out in the industry so that you can participate in those market returns and maybe decrease your overall risk as well. It's a great time to get invested, to get started, or to revise your current plan.
You being a trusted Brookstone advisor, I mean, we can talk for hours about any number of topics, but there's two things that come to mind today, right? Two of the things that we are known for, that you are known for as a Brookstone advisor. We can talk about risk management a whole lot and how we can deliver really incredibly competitive returns, but take the level of risk that a client's taking, the volatility, the swings in the portfolio way, way down while still participating in the market. So that's a topic people, for that alone, the call to action should be, let's do a risk management calculation of my current portfolio with Marissa. That's number one.
Mhm.
Number two, we talked about structured notes being higher income producing vehicles with this lower risk. Income planning, I think we've been again really focused on the demographics of America today, where you don't have pension plans like maybe our grandparents' generation did, right? Pension plans have gone the wayside. People need more income to live. They're living longer. Of course, we know there's
Mhm.
inflation. And so we've made a point of having a real expertise on the income side of portfolios to help clients with, again, innovative ideas, get the income they need. That to me alone is worth a meeting with you to see, where they might be able to actually add more income to their portfolio. And then, of course, that whole risk management side as well.
Absolutely. I think, one of the first conversations we have with clients is about risk. And of course, 99% of the people that I sit down with want the highest possible return with the least possible risk and
Right.
100% liquidity. And
Right.
well, yeah, wouldn't that be perfect? But it's a matter of fine tuning that to get a realistic rate of return, minimize that risk, have a level of liquidity, not on 100% of your assets, but on the amount that you need. So, what would you say Brookstone's investment philosophy is on risk. What kind of tools do you use with your clients or recommend your advisors use with your clients, whether that be buffered ETFs, annuities? Talk me through that.
Yeah, yeah, absolutely. I mean, so of course we believe that every client needs to have custom attention. Let's start with that. It's customized attention to your specific needs. So we do a lot of what we call goals-based planning. It's not cookie cutter. It's not trying to chase the market or the benchmarks. I use the phrase S&P 500 envy sometimes, right? Clients are seeing the S&P 500 ticker everywhere. Their neighbors bragging about their 401k. And it usually leads to some bad decisions, right? If you look at investor psychology and behavioral finance, and a little bit of FOMO, I throw that in the mix, Marissa, right? And
Yeah.
sometimes it's like, oh, clients tend to buy high and sell low because of the wrong reasons, emotions and FOMO and some of that behavioral finance that kicks in. We want to ground our clients on the goals that the client has, doing a proper plan, building something that has an absolutely durable way to meet their goals, and revisit that plan, revisit the portfolio, of course, multiple times a year. It's not about beating the S&P 500, I can guarantee you. This is about a durable plan that a client can then meet and satisfy every one of their stated financial goals. Where most other firms get it wrong is they lead with performance. They lead with trying to beat the benchmark. They might try to say we're going to pick the best stocks, right? That's where you're going to go wrong more times than not. I tell clients all the time, turn off CNBC, forget all that stuff here. We are here to really customize a plan for you. Now that you know what Brookstone brings, a heavy dose of risk management, pioneering, forward-thinking strategies, very, very heavy on the expertise on the income side. We've built these portfolios around a plan that almost every single time in my almost 30-year career, we've actually said never had a client not meet their goals, number one. Most important to me personally and to all the Brookstone advisors is that we build durable portfolios with downside protection, and that is important because if you plugged in a large negative number in the sequence of a client's returns, you would see that it's very destructive and catastrophic to the actual growth of the dollars and therefore you meeting your goals. So what you're getting with Brookstone is not trying to outperform the market, not trying to pick hot stocks. It's durable plans that can allow you to meet your goals very, very safely over, what we now know is a 20, 30, 40-year retirement horizon.
Mhm.
You need the right advisor with the right plan.
Well said. And it is so true. I don't know anyone that would, after understanding and talking through it, rather earn 22% and have a lot of risk and no plan than earning, let's say, 19% with limited losses in down market years, consistent guaranteed income, being able to reach their goals, whether that be putting their children through college or taking those family vacations. All of that is so much more important than always making the most highest return out of any of your neighbors, which half the time the neighbors aren't even telling the truth anyways. Let's be honest.
Absolutely. And Marissa, I mean, this might come across as a shameless plug, but I'm going to say it anyway because it's really the truth. I mean, we've worked with each other for some years now, and you are among the finest advisors in the country. I mean, I say that, and I know it's true.
Thank
You
you.
care, you're competent, you're diligent, you're smart, you're sophisticated. So, clients would be just thrilled to sit down with you, even if there's no obligation. It's just kind of a free checkup or a review. But you are among the finest. And I say that very proudly because, of course, we're in partnership through Brookstone. And it just excites me to think that, you can help so many more people that might want to meet with you.
Thank you, Dean. That means a lot. Now, you've been such a visionary, as we know, in the independent advisory space over the last 30 years. Where do you see the industry evolving to over the next 5 or 10 years? And what action would you recommend someone take that is listening to this today?
Well, it's great. So I think the strategies that we employ, they're going to continue to be refined and come to market with even more focus on what Americans in this generational level need, which again, we've talked about, we've been there already, risk management, avoiding large losses, durable plans, and then income being that other thing that we all need, most of our clients need. So I think the industry is finally there. I think we were ahead of the curve 10, 15, 20 years ago.
Mhm.
So that's one part that we look at very closely. There's been a plethora of ETFs that have come to market that we've used. We were almost first in line using buffered ETFs, as you know.
Yeah,
Very
give me a quick little rundown on those for anyone listening that's
sure.
wondering what is a buffered ETF.
A buffered ETF is a way to buy an exchange traded fund that gets you a predefined outcome on day one. And usually it looks something like this. If you hold that ETF, which is liquid, it trades like a stock daily, for the next year, we're going to give you all of the upside of the S&P 500 hypothetically, with maybe a cap. Maybe the cap is 15%. We don't get all of it,
Mhm.
but you're not going to participate in 10 or 15% of the first downside. There's this hard buffer, we call that, where you don't participate in that. So it's defined outcome investing. You know upfront exactly what the up and the downside is, the risk and the reward. That is like a structured note where it's defined outcome.
Mhm.
Buffered ETFs are sort of the first cousin of the structured notes we've talked about. Again, we've been on
Yeah.
the forefront of this. I'm excited to talk about it because I think the industry needs more products and solutions like that that give you
Mhm.
that sort of transparent investor experience. And again, I focus on those two words, the defined outcome. You know upfront what you own and what those kind of potential risk reward or up and downside solutions might be over that year.
Mhm.
So that's huge. And the industry is not stopping. It will continue to innovate across this category of what I say defined outcome.
Mhm. Yeah, I think there's so much uncertainty in life and the world these days that to have some investments that are defined outcome can give the client so much peace of mind. And what would you say to someone that's been either investing by themselves, doing their own stock picks, or only has that 401k at their employer? What would you say a first action would be to take if they want to start working with an independent advisor?
Yeah, I think the first thing is if somebody's serious about having a long-standing, durable portfolio that's not just what the 401k offers or just the usual 60/40, is to get a portfolio, what I say X-ray or evaluation done, right? You call Marissa and you sit down and you have a thoughtful meeting about what that current portfolio looks like. And then how that portfolio, as it's currently constructed, how does that sort of fit in the mix of what your other goals might be, Mr. Klein, right? There might be a mismatch between the way your portfolio is built and what you're looking to accomplish over the next 30 years of your life, right? Maybe it was right for you 10 years ago because you were in growth mode and you were working and gainfully employed. But that's the key is life happens. People, of course, have shifts in their lives and their goals as they get close to or they do retire. And so doing that portfolio evaluation is the key. And that's where you can come in to make sure you
Mhm.
can ground a client on here's what you currently have, but let's just make sure that this meshes well with all these other goals you might have, somebody that might be thinking about or already retired.
Absolutely. For anyone that's listening to this or watching on YouTube, all you have to do is go to union-financial.com and click schedule a meeting where you can book a Zoom call, a phone call, or an in person meeting with someone at my office or myself. And we can do that risk evaluation for you. We can do that checkup and totally look at your portfolio, see if there's any tweaks that we can make and recommendations we can have for you. It's always complimentary to have that review, and you have nothing to lose. Get that second opinion. And for anyone else that's an advisor, maybe watching this episode, and you're thinking that Brookstone could be an amazing partnership for you, and you want to have the same access to solutions that I have, by all means, Dean, how can they get in touch with Brookstone?
Well, I appreciate that. www.brookstonecm, like charliemary.com. And we have a page there for advisors. You can express interest and you can fill out, a little form and we would get in touch with you. I think, we're really proud of the fact that after Brookstone celebrating its 20th year anniversary this year and 13 billion of assets, we feel like we've helped tens of thousands of families and we're still just getting started. There's a tremendous amount of love and passion for what we do here. And I think that resonates down from me and my team here down to advisors all over the country like you, Marissa.
Mhm.
The passion is there, the desire to help people is there. I'm going to add one more thing. People talk about portfolios and performance, and everybody's talking about, maybe the Magnificent Seven and stocks. And again, I think they get it all wrong. I want to make sure our listeners know that there's so many other things that Brookstone advisors like you do for a client. It's not just about building the right portfolio, which is a big part of it. There's other things we do that most clients are not aware of, right? I talk about income planning. How about tax planning? How about RMD planning to make sure we can do the RMDs from your IRAs and 401ks in a proper fashion? We
Yeah.
talk about estate planning, education planning for kids and grandkids, charitable planning, legacy planning. There's so much more you get from working with a licensed independent fiduciary Brookstone advisor.
Mhm.
It's not just about the portfolio. It does start there, but we build this plan around all these other disciplines that a
Mhm.
fine advisor like you will help clients, not just portfolio planning, everything else as well.
Absolutely. It's truly a comprehensive relationship and it's personal. We know our clients well. We know their family, we know their goals, we know when something important in their life is happening because we're helping them get there. It
Yeah.
is so important to have that advocate in your corner when it's your money. It's what you work so hard for. Sometimes it's your life savings. It is important to have a true person behind you. So if you are watching this and you know someone that loves the stock market or this resonated with you, please share it with friends or family and make sure you're subscribed to our channel. Dean, thank you again so much for coming on. I'm so fortunate to be partnered with Brookstone and have you as a mentor.
Oh, it's a pleasure. Marissa, you're awesome. You're incredible. It's a great partnership and look forward to working with you for many years to come. We appreciate you.
Thank you. And thank you all for tuning in to another episode of the Future of Finance podcast. I'm your host, Marissa Wood. We look forward to helping you live a better financial future. Investment advisory services offered through Brookstone Capital Management, LLC, a registered investment advisor. BCM and Union Financial Services are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. The opinions expressed by Marissa Wood and guests on this show are their own and do not reflect the opinions of this radio station. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risk and otherwise stated are not guaranteed. Past performance cannot be used as an indicator to determine future results. Any strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it's suitable for your specific situation. This program is designed to provide accurate and authoritative information with regard to subject covered. Index or fixed index annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charge as described in the annuity contract. Guarantees are backed by the financial strength and claims paying ability of the insurer. Please refer to our firm brochure, the ADV 2A Item 4, for additional information. Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone.